One of the things that's changed a lot for the Fed is that they've become a lot more transparent. If you rewind back, let's say 2, 3 decades ago, you had Alan Greenspan as chairman, and he just kind of mumble and shrug, and no one really know what he thought, no one really know what he was doing. But today things are completely different. So, um, right today, Fed Chair Powell gives press conferences, has meetings, and all the Fed presidents give lots of speeches. They try to be transparent to help you understand what they're thinking. There was a time when the Fed would raise rates and they wouldn't even tell you about it. You'd have to kind of guess whether or not they raise rates. Today, they tell you they're raising rates and they give you an idea of whether or not they're going to raise rates in the future. So it's a very different setting. So back to your question, the Fed cares about full employment and price stability. Basically, they want everyone to have a job and they want inflation to be under control around 2%. And they're not doing very well on that second point. And so what the Fed has been telling you over the past year is that usually they're a one mandate bank, but for now, usually they're a two mandate bank, but for now they're going to be a one mandate bank because employment is at record lows, inflation is at multi-decade highs. They're going to try to keep rates high for the foreseeable future to try to slow down inflation.
It's about what is money, and then we can go into who creates it, the monetary policies, and all those kinds of things.
So what you think of as money really depends on who you are in the financial system. So if you're retail like me, money is obviously currency, right? Pieces of paper and what you have in your deposit account at a bank. Pieces of paper, that's currency that's printed by the US government. Your deposits in a bank are actually not guaranteed by the government. As many have suddenly discovered, they're actually an IOU from the commercial bank. But we think of that as money. If you have less than $250,000 in a bank, you're guaranteed by the government. So that's basically risk-free money, right? So that's fine. But if you are a large investor or if you're a corporation, you obviously can't have, you obviously have more than $250,000 in the bank. So for you, you really can't think of that purely as money because there's credit risk. What do you do then if you have, let's say, $1 billion you want to put somewhere? You could just, have briefcases of currency like Scrooge McDuck and just hide it in your basement. You could put it in a bank, but then you have bank credit risk. But if you are a large investor or an institutional account, usually what you think of as money is treasury securities. Because if you think about it, treasury securities is an IOU issued by the US government. It's kind of just like a $100 bill, except that it pays interest. So for big accounts, institutional investors, they think of money as US treasuries. Now, many of you will think that, well, treasuries is nice, but then I can't really go and buy dinner with it at KFC, right? No, you can't, but the treasury market is really special in that it's very liquid and very deep. So if you had $1 billion in treasuries, yes, you cannot use it to pay for dinner or buy a car, but you can easily sell it in the market and get bank deposits and use that to buy stuff. So because of its liquidity and its lack of credit risk, it's very safe. It's money, a form of money. And the last type of money that I'll talk about is what banks think of as money. So we put deposits at a bank, and our bank deposits we think of as money, but what about banks? What do they think of as money? So banks have money too, and they think of money as deposits at the Federal Reserve. Every bank has a checking account at the Fed, and that's basically where they get their money that they use to give to us and to pay other banks. Those are called reserves and what banks think of as money. Now, understanding these different kinds of money in the financial system can be really helpful in understanding how what the Fed does and how the monetary system works. I'll give you an example. So remember, after 2008, the Fed was doing quantitative easing, right? They were printing trillions of dollars and buying stuff. Many people saw that and said, whoa, the Fed is printing trillions of dollars. We're going to have hyperinflation. Better buy gold, better buy guns and canned food. But that didn't happen at all. In fact, for the decade after the great financial crises, there was very low inflation. The reason is that people misunderstood what was actually happening. So the Fed was printing a whole bunch of money, so money for banks, reserves, and using that to buy treasury securities, which was another form of money. So you can think of it as printing $20 bills and using it to buy $100 bills. obviously, you did print money, but then you used it to buy other forms of money. So at the end of the day, the actual purchasing power in the economy didn't change. Another way to think about this is, suppose that I had $100,000 in U.S. Treasuries in my trading account. Let's say I sold it to the Fed and in exchange had $100,000 in deposits. The Fed printed $100,000 and bought it from me, but at the end of the day, instead of having $100,000 in Treasuries, I got $100,000 in deposits and my purchasing power is unchanged. The difference is that financial asset prices responded strongly, and which is exactly what the Fed wanted to do and exactly what happened. So if you understood quantitative easing, you could have saw that it would not be real economy inflation, but the financial asset inflation, including interest rate sensitive assets like real estate, would have been very helpful.
You guys get this book. I had to read it. I had to read a couple of the chapters more than once just so I could get on this Zoom with Joseph. It's very, very, very good too. He is going to be at Limitless. We'll put the link in here for you. And that is in Scottsdale on June 15th, 16th, and 17th. So you'll be able to meet him and he'll be able to sign your book and you'll be able to ask him whatever questions you might have. That's going to be exciting to have you there. It's also, we're going to have George Gammon there. We got Mark Moss there. We got Robert Kiyosaki. So that's going to be quite the debate, because I think the Fed's meeting a couple more times between now and then. And of course, the CPI, who knows where it'll be at that point.